In contrast, gold has no limit on its face value. It is limited in its supply in physical terms, and it reacts really, really well to negative real rates that the West needs just to not default on its debt nominally. So, it would ultimately set up a situation where gold goes higher in yuan. That means creditors of China, commodity suppliers of China, have more gold that goes up in yuan. They can, if they want, use that as collateral or sell it in, arrive at more yuan, which means they can buy more Chinese goods, which means China buys more commodities from them. It's a virtuous cycle of trade they're setting up. It's so crystal clear to me what's happening here. And the net of it is that gold surpasses treasuries as the number one reserve asset in the world. Then you have to ask yourself, if gold is the biggest reserve asset in the world, are we still in a dollar standard? Think about that.
Here's what's quietly happening behind the scenes. The global gold market is being rewired, and China's at the center of it. Luke Gromen says the plan isn't for countries to suddenly trust China with their gold. Instead, the idea is to use Shanghai Gold Exchange linked vaults in neutral hubs, places like Saudi Arabia, India, Brazil, or Dubai. Gold could be stored and settled there, outside the Western banking system, cutting out counterparty risk while still letting the yuan play a bigger international role. Gromen points out that China's been laying the groundwork for this for over a decade. They've set up offshore yuan clearing banks in key gold centers like London, Dubai, Singapore, and Switzerland. Step by step, they're creating the infrastructure for what looks like a gold-based yuan system, not gold-backed in the old-fashioned way, where a currency was pegged to gold, but one where gold becomes the reserve asset that underpins trade and finance. The distinction matters. U.S. Treasuries, which have served that role for the dollar since 1971, are unlimited and rely on negative real interest rates to keep the U.S. government afloat. Gold, by contrast, is finite, and it tends to rise when real rates go negative. That dynamic creates a feedback loop. As gold's value climbs in yuan terms, China's trading partners, commodity exporters like Russia or Middle Eastern states, see their gold reserves appreciate. They can then use that added value as collateral or convert it into yuan to buy more Chinese goods. It's subtle, but it's a powerful shift taking shape. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that actually understand what's unfolding. Thanks for watching.
India, even just today, Bloomberg headline reportedly buying oil from Russia in Chinese yuan. And so this would fit into the model of the internationalization of the yuan, multi-currency energy pricing with net settlement in gold at the central bank level. And everyone always says, oh, I'm not going to trust the Chinese with my gold. Good on you. You probably shouldn't. But if it's a Shanghai Gold Exchange vault sitting in Saudi Arabia, sitting in India, sitting in Brazil, not a lot of risk there, is there? Chinese aren't going to come get it. It's sitting, and so that's what I think. Ultimately, I think we will see headlines eventually indicating those moves. Haven't seen them yet, and it would all fit into the yuan offshore clearing banks, or the offshore yuan clearing banks that we have seen the Chinese establish per the IMF in the UK, major gold trading hub, in Dubai, major gold trading hub, Singapore, major gold trading hub, and Switzerland, major gold refining hub. And like I said, I think it's ultimately, it's very clear to me what they're doing. I don't know why there's really any argument about it anymore, which is, as the late, great Harold Malmgren said in 2019, the Chinese are moving to a gold-based yuan, not gold-backed. They're not tying it to gold. No one's going to tie it to gold. It's gold-based. Gold is serving as the same role that the treasury bonds served at in the post-1971 dollar system, except face value treasury bonds can't float, and the supply of treasury bonds are infinite, and the U.S. needs negative real rates on our treasury bonds just to keep its fiscal math on the car, or fiscal wheels on the cart. In contrast, gold has no limit on its face value. It is limited in its supply in physical terms, and it reacts really, really well to negative real rates that the West needs just to not default on its debt nominally. So it would ultimately set up a situation where gold goes higher in yuan. That means creditors of China, commodity suppliers of China have more gold that goes up in yuan. They can, if they want, use that as collateral or sell it, arrive at more yuan, which means they can buy more Chinese goods, which means China buys more commodities from them. It's a virtuous cycle of trade they're setting up. It's so crystal clear to me what's happening here. And the net of it is that gold surpasses treasuries as the number one reserve asset in the world. And that sounded crazy when I started saying it a few years ago, but as we saw the FT report last week, had on our X feed, we're like a month or two away from that happening. So, then you have to ask yourself, if gold is the biggest reserve asset in the world, are we still in a dollar standard? Think about that. I would modify that just slightly to say that I think running it really hot will bring debt down. All else equal, if they run it really hot, as I think they ultimately will. Look, to answer your question, I think gold to oil ratio, while high historically, I think it's likely going higher over time. In my opinion, oil over the next few years probably trades in US dollar terms at the highest marginal barrel cost in the world, plus 10% or so, right? So, if the break even on shale is 70, oil probably trades 77 to 63 to 77 on relatively low volatility, and the release valve to any related inflation around running it hot is going to be gold. We're already seeing this. This isn't speculative. Empirically, we're watching this happen, and because it's different than the oil-led inflation and with a fixed gold to oil ratio, basically within a range of the prior 50 years, people aren't seeing. We've gone through a change. The market is playing by new rules. Gold is the release valve now for inflation and for running it hot, not oil. Why? Well, if gold skyrockets, it adds to global demand via Chinese consumers who own a bunch of gold, Indian consumers who own a bunch of gold, Arab consumers who own a bunch of gold. If oil rises sharply from here, it breaks the global economy. You can't have oil spike here with U.S. debt to GDP at 120%. You just can't. You're going to break the treasury market. And as soon as that happens, you go into a debt spiral. Because oil prices spiking leads to real economy inflation and stagflation. It takes away from other parts of the economy. So from both an empirical structure and a strategic reason for it, look, I don't think, I think oil is going to be fine, but I think oil is going to trade at marginal oil barrel cost globally, plus or minus 10%. And, gold's going to be the release valve. Price and valuation is arbitrary, as one of my mentors in the business told me. So a long time ago, many times. What are you going to sell it for? Why? What are you watching that makes you want to sell gold for what? For dollars? The American government's printing money to buy commodities, and you want to sell gold to get the dollars they're printing to buy the commodities? Not what I want to do. But again, it depends on waiting. It depends on personal situation. It depends on, are you 5 years from retirement? If I was 5 years from retirement and I had a huge position, I'd probably take them off the table. So I don't like putting that kind of position on in the first place. So it's an intensely personal position, but I do think it's important around how big are you? Are you levered? Don't be levered. If you're levered and like wildly long, and it takes them off. If you're not levered, if you're not that big, if you're not that close to retirement, if you're, if you have something really interesting on the other side to buy, that it's, very positive cash on lever returns, and sure. So I would just encourage people to, know what you're doing, why you're doing it. That's all. And I think that's an individual decision for every person involved.
Luke Gromen paints a pretty stark picture of how fragile paper gold can really be. Imagine this: gold's trading at $10,000 an ounce, but you're holding an unallocated position, just a claim on metal sitting somewhere in a vault. Your custodian calls and says, "We'll settle in cash at $4,000. You can go buy the gold yourself." Except you can't, because there's none available. In that kind of market stress, some institutions could even declare force majeure, basically saying they're legally off the hook for delivery. They'd keep the physical metal to patch up their own balance sheets. That's why Gromen keeps repeating one point: if you don't own actual gold, or properly allocated bullion, you don't really own gold at all. The only way to eliminate that risk is to hold physical metal or use a custodian who guarantees specific bars in your name. He also notes a generational shift that's changing where people park their wealth. Younger investors aren't chasing property the way their parents did. They're turning to Bitcoin. Measured in Bitcoin, home prices have been dropping for years. That's not just market noise. It's a sign that digital assets are slowly taking over real estate's role as the preferred long-term store of value. Let's get back to the interview.
Hey, gold was at 4,000 on Friday. Gold's at, I don't know, 10,000 on Monday. Um, we will pay you, you own an unallocated gold claim. We will pay you $4,000 cash. You go source your own gold. And you have to buy it at 10,000 in the market on Monday. Sorry about your luck. You should have bought physical in the first place. Uh, you know, certain custodians could do that. That would be effectively declaring force majeure. It's not unheard of in extreme situations. And they'd probably, if they had the gold on their books, keep the upside themselves to recap their own books. Which custodians? Don't know. Would any of them do it? Don't know. Maybe none would. Would it happen at all? Don't know. But I think the really important thing to highlight is there's a really easy solution to preempt all of the risk of this, which is just buy gold. Buy gold, physical bullion, and or allocated bullion with a very trusted custodian. And then you don't have to worry about it. Then you can sleep better. I mean, you're seeing it, all this AI bubble, the AI bubble, and I'm not opining on whether it is or it isn't. There's certainly signs that I can understand why people are making the case, but in the end, I don't care. I'm not trying to bet on that war. I'm trying to sell picks and shovels to both sides of that war, or trying to sell weapons to both sides of that war. And the the people selling picks and shovels to that are a lot of the companies in the pave. It's the electrical infrastructure. And I'm still hearing years of open field running in terms of infrastructure build out, refurbishment, etc. Trump was talking about it earlier today. From Andrew, what do you expect to happen to home prices in the next few years? Will those prices keep inflating, or will higher unemployment rates finally make a noticeable impact? A good question. In my opinion, I think it's going to be a lot more. I think home prices are going to be a lot more local market specific, area specific, type of homes specific. Look, insurance on ocean, near the ocean type stuff, I think it's probably going to keep going up. And if you've got two mortgages and an insurance payment and a homeowner association payment in Florida, there's not a lot of room for price appreciation, and you're seeing that in certain parts of Florida. I think property taxes, particularly in traditional higher cost blue areas, property taxes probably gonna have to go up because they're bumping into problems with pensions. If your property taxes go up, the value of your property doesn't. I think boomer McMansions, so to speak, and condos probably run into problems in certain areas in terms of being oversupplied relative to the next marginal bid from their kids. Uh, I think certain areas that are starting to kind of come off the lows are probably going to keep doing so. By me is a perfect example. Cleveland did nothing for like 20 years. And then like this last 4 years, it's up like 60%. Some of it is just a quality of living, right? Low cost of high quality education, lower cost of insurance, a good place to raise a family, and across sort of the Midwest, second and third tier cities, I think probably do okay. But now you're still going to have probably some period of time where AI does drive unemployment. That's a problem, I think, for all housing. I agree. And I think particularly for the younger generation, like I think Bitcoin, forget about what I think. Empirically, Bitcoin has been demonetizing housing. It has. Look at the price of a house in Bitcoin. It's collapsing over the last 5 years. I think that's going to continue. And I think while the older generations look at that as Bitcoin as a bubble, I think the younger generations look at that as it's demonetizing of housing. Some part of the home prices we see is because people have bid it up as a store of wealth. And so to the extent we see things like Bitcoin being used as a store of wealth more by the younger generations than the older generations, which we absolutely are, then I think housing in Bitcoin terms is going to keep collapsing. And so long story short, I think you want to buy a house, buy it to live in, buy it to raise a family, and buy it because the school system's good. Don't buy it to make money though, because I think the days of the last 30, 40 years of where interest rates only go down and to the right and home prices only go up and to the right, that the older generations caught a nice wave of, and good on them. I think those days are over. So that's how I would think about housing from here. I think it's a deeply individual, local, niche, personal decision. I don't think it's any more sort of just buy it all and hold it.
Something big is shifting beneath the surface of the global monetary system, and gold is quietly becoming the pivot. What once served as a static reserve asset is now being woven into a new financial network, one where trade, trust, and settlement are moving away from Western control. The framework taking shape isn't about a sudden return to a gold standard, but about building a parallel system where physical metal, not paper claims, underpins value. As this structure expands across regions like the Middle East and Asia, it's challenging decades of dependence on dollar-based instruments. At the same time, a younger generation of investors is rethinking what store of value even means, favoring tangible assets and decentralized alternatives over traditional wealth models. The transition isn't loud, it's deliberate, structural, and irreversible. The real question now is whether this quiet reordering of the gold market signals the early stages of a new monetary era, or if it's just the prelude to something even larger waiting to unfold. So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for the support, and I hope you enjoy the video.